Hey, everybody, this is David Paul, the host of the Capital Stack podcast, where we talk to founders, entrepreneurs, operators about all things tech investing and startup business creation. Today, I am with John Mizzi, who is the founder and CEO of Vero Technologies and Lever. Vero Technologies helps banks and credit unions offer a diversified set of commercial credit products to better serve SMBs in their communities. And Lever offers floor plan leasing to auto dealerships to better finance their inventory. Prior to Vero Technology and Lever, John was the CSO and COO of Bond.One, which was a capital markets technology platform focused on streamlining settlement and reconciliation functions for asset servicers. And he was also the VP of strategy and marketing at CBX Market, which is a portfolio management software solution for investment managers. John, how you doing?
I'm good, David. Good to be with you.
How do you manage your time being a CEO of two companies?
Well, it's an interesting question. I've gotten to a point now where the reality is the only time I really have for deep, thoughtful reflection and uninterrupted work time ends up being Saturday mornings. But I really have kind of tried to optimize my week so that I can front load, the more thoughtful conversations and modeling exercises and things like that on the front half of the week. Inevitably, by Thursday, Friday, there's a bit of brain drain, just from exhaustion of everything going on. So I actually like to end my day somewhat early Friday afternoons, recoup, recover, recognizing that I still am going to be able to be productive and get ahead Saturday morning, and then really set myself up for success the following week.
Do you have kids?
I am very single, which
Okay.
I'll admit it's hard to imagine going through this journey and necessarily being responsible to others or having a family. But
Yeah.
my co-founder Isaac is married, and so I know there's ways that people can do it. I'm fortunate to benefit from having a little bit more of a selfish schedule.
Yeah, you should do like what Ray Kroc did with all of his franchisees, which is just make sure the wife is at the closing dinner when trying to recruit people to make sure that
Yeah,
she's on board for the treacherous road ahead.
absolutely. I try to let everyone else insulate themselves from weekend work and definitely carve out more time for the family. But right now, my baby is the business.
But that's going to be like, I mean, pretty hard. I mean, I see a lot of founders. It sounds like you're pretty aware, but I know a lot of founders that are, completely married to their business, don't have other relationships, and they're sending out scathing text messages and emails at 3 a.m, giving their employees anxiety attacks. Right, total lack of boundary, especially now when everything is on Slack and text message and Zoom.
Mhm.
I mean, I mean, obviously that's not your style, but I definitely see that can be a thing.
Well, I definitely wake up in the middle of the night and I'm thinking about things, and I don't hesitate from sending out the flurry of Slack and email messages. With that being said, when we onboard all new folks, we have everyone do call it an intake form where they can specify their preferred work times. When do they like having meetings? When do they want to be able to do deep focused work? And really, the exercise is meant to accomplish two things. First is just to get a better sense of what the working styles are of the people that come on board, and the other is to have a conversation to set expectations where I can convey, like, look, I am going to do what suits me, which is sending out those middle of the night Slack messages as I'm thinking about something. With that being said, there is no expectation that you need to respond to those things until you're back at the computer the next day. The worst thing, and I experienced this myself, is waking up in the morning and I try to not look at my phone first thing that I do, but inevitably some mornings I do. And then getting triggered by something that came in overnight. And so my goal is really to help everyone else get comfortable with that. They need to manage themselves first and foremost to be successful. And then only when they can be successful in their role in the business is the business going to be able to function over the long haul.
Right, because when you're sending out your emails, that essentially is kind of like your checklist, right? You're executing task by task. There's a system of record that shows, what's been sent to who, and
Mhm.
but that doesn't necessarily mean like I need this back right away. This is just my process.
Yeah, and we even kind of set a hierarchy of, anything that needs a immediate response next time you're available is going to be Slack. Email, the expectation is that you're going to respond in the next 12 hours unless it's a weekend and you can respond on Monday. If there's anything over the weekend that I need, I'm going to send you a text message, but I try not to do that. And then, really, obviously, we have our scheduled routine calls, which kind of keep the communication flow functioning without having a lot of ad hoc, outreach.
Awesome. And so, how many employees do you have right now?
We are up to 11 onshore and about 15 offshore.
Awesome. Super, super awesome. Well, why don't we just take it? Why don't we just start with the business, both businesses, both Vero and Lever, and then we'll kind of talk a little bit about your background, and But first, let's talk about your business. What does it do, and what's the problem you're trying to solve?
Yeah, absolutely. So we recognized, and this was from the experience I had in a prior role, but that there was a gap in terms of firms focusing on providing inventory financing to dealers of manufactured goods. So we're talking about auto, boats, RVs, zero turn lawn mowers, spas. There's 17 different verticals of manufactured goods that are distributed through dealership networks. And typically, all of those dealers are using some type of inventory financing. And so, digging into the space a bit deeper, we were really confused because all of these dealerships were primarily working with their local community bank in order to for generic business banking services, but then they were having to go to X specialty finance company to get the inventory financing line of credit that they're looking for. And so we found that many of these banks had tried to do inventory financing, did not have the scale in order to justify the investment in systems that they needed, and did not have the specialized headcount within their credit organizations in order to actually administer, a diverse set of commercial credit products. So the gap that we really set out to solve is really there's kind of two sides of the market here. There's banks that want to offer a wider array of commercial credit products, but simply don't know how to do it or don't have the scale to do it on themselves efficiently. And the other side is this community of dealers who have really been left to work with specialty finance companies where the cost of funds is high, the borrower experience is low in terms of quality, and their preferred financial services provider is, in fact, the community or regional bank in whatever market that they're located in that they have a history or a relationship with. And so we've really tried to tackle, both of those problems, albeit in slightly, different cadences. And so that really, that's what we were working on at Vero, which is the parent company. We ultimately launched Lever, which is a balance sheet lending organization, as a subsidiary of Vero, because we knew that in order to sell into those banks, we needed to have a track record of operating as a lender ourselves, not only to build out the kind of services function that we offer to the bank, but further because as acting or operating our own lending platform from a product development standpoint has allowed us a built-in feedback loop so we can iterate on new solutions and tools to administer our own lending platform and at the same time license that technology and our services organization to the bank.
Okay, right on. And so, are you focusing on any particular like dealer network or vertical within manufacturing that
Yeah, so we got started with auto as our beachhead. And that simply is because inventory financing is a somewhat mature product among auto dealers, albeit there's a lot of churn. And I would say, from a penetration standpoint, there's a lot of opportunity in terms of where we can take that market opportunity. With that being said, we've since moved into um, marine RVs, power sports vehicles, really because the kind of dynamics of inventory financing for that subset of dealerships is very similar to auto. Beyond that, we'll look at doing more specialty stuff, whether that's the zero turn lawnmowers, spas, motor coach vehicles, etc.
Okay. All right. So that's interesting. So you pivoted away from the car dealerships.
We still do focus on auto as our kind of core vertical, but we've extended the scope of the platform services to cover those other verticals that I mentioned.
Got it. So what was the learning behind the car dealerships?
Um, really that the interesting takeaway is we're talking about SMBs at the end of the day. So we
Right.
had a very sophisticated underwriting model that was heavily based on their financial reporting in order to determine credit quality of these dealers. And the reality is that, as is similar with just about any SMB that you're looking to underwrite, the quality of financial reporting isn't always there or is not necessarily thorough or robust enough to really uh, lean on exclusively in terms of determining creditworthiness. So we've had to look at a variety of different alternative, call it characteristics or data sets that we could utilize in order to determine, quality of financial and operational performance amongst our dealers in order to actually to effectively underwrite the lines of credit that we extend them.
Yeah, so that's really interesting that you said that because I remember when, I was looking at the Vero deal, and I think you're raising on a fund. And I was, making some introduction, or excuse me, I was making some connections for me to kind of understand the space better. And I did hear something to that tune, is that, the long tail nature of these independent dealers, they don't have the data, right? Or it's
Mhm.
so disparate that it's hard to roll that out at scale. And for that reason, I passed, but I'm also an idiot, right? Because I don't ever account, I always look at a business on how it's going to be today and not what it could be, and taking into, for granted, like where the pivots can be, how resourceful are founders. And I'm going to, rue the day that I did not invest, because it sounds like you're absolutely killing it right now. Um, which is awesome.
There's a long list of VCs who fall into the same bucket as you, sir. So don't take it. Don't feel too bad about it.
Good. Yeah, because my bar is not too high. I just want to be good enough, right? Like I want to be the good enough VC, not I want to be exceptional. Um, so let me ask you a question, my man. Tell me like from a fintech perspective, you have to offer, you talked about needing this data to algorithmically determine creditworthiness, and needing to understand, the different kind of drivers and variables. What does a product need to look like in fintech to be able to do that?
Yeah, I mean, at the end of the day, and this is an interesting kind of vector to evaluate, but in my mind, there's no fintech solution that's just a all-in-one, build it from the ground up, standalone solution. You would be silly to invest the time and resources into building a credit platform that doesn't utilize data from other embedded solutions. So whether that's using open banking tools like Plaid, thinking of different alternative data providers that are out there that allow you to get a deeper perspective on your customer based on their interactions away from your platform. To think more specifically, we all of these dealers are using a variety of other technology tools, whether it's a dealer management system, a marketing and website solution, some type of inventory management tools, but they're creating a lot of public facing content. And so even social media reviews amongst dealers. So looking at, it's not just what's the rating on Google for a dealer, but if there is a 1-star rating from someone, how is the dealer responding to that rating? Is it polite and conciliatory and, let's put our heads together to find a solution? Or is it, well, screw you, it was a buy as is deal, and so not my problem? And so you can really suss out more, call it character there's the 5 C's in credit, character being a very important one of those. And you can suss out, character as a vector by which to evaluate the dealer using these alternative data points that are all in the public domain, but not necessarily what a traditional credit risk officer might be looking at.
Right. And so a lot of the intangibles, right, that a business might have. And so when underwriting this kind of stuff, it's more than just working capital, days outstanding, aging receivables, any of that stuff. There's a whole lot of litany of other, things that you put in your calculus to see if they're creditworthy.
Absolutely.
Okay. All right. So you just raised a round, I heard.
Yeah, so we closed a $4 million seed round at 16 million pre-money, and we also, in parallel, took on a $50 million credit facility to really fuel platform growth in terms of our lending activities. Um, we're fortunate in parallel to that as well. We've also lined up a handful of banks for lending as a service engagements, which is really what I was talking about earlier, where we partner with the bank to help them offer or sponsor an inventory financing program. Consider the program to be powered by Vero. We're the servicer and administrative agent on the program, but the bank is actually able to fund dealers directly through our platform um, on a one-to-one basis. So that allows the bank to really market inventory financing to the dealers in their local communities without ever investing in upfront, in building out specialized headcount or adopting any additional systems in order to offer the product.
Yeah. Okay. And so you said earlier that you had to kind of prove yourself as a lender to begin with, basically being your own balance sheet. So when was the chasm that you were able to bring on more institutional investor versus basically using it off your own balance sheet?
Yeah, I mean, it was a process that we started in July, August of last year. We frankly started talking to private credit shops about the credit facility before we even thought about our seed round. We quickly learned that in order to take on a meaningful amount of debt, you have to have a bit more cash on your balance sheet for that matter. So, started a process that we ran in parallel, doing both the debt and equity raise. And, that was obviously came with its own unique set of complexities. Trying to do your initial seed round as a balance sheet lending business is it kind of precludes a lot of venture investors from actively participating. But we were able to zero in on a group of folks who understood the auto finance business, who understood specialty lending, and who really, believed in the team that we had put together to execute on the vision. So we're definitely fortunate. We're very excited about the population of investors we brought on board, and we're ready to go to town from here on out.
But before you raised the seed round, didn't you raise some like LP money for a credit fund?
Yeah, so that actually, took a few different or the shape of that investment took evolved really even since you and I had spoke initially. So rather than doing a fund structure, which was just going to create a lot of overhead in terms of legal expenses, we ended up taking on corporate debt from a parent company perspective. So it was a bit of a quick and dirty solution. And it was one of those things where we took on $1 million initially. Once we worked through that initial $1 million, we took on two more. And so it was, just biting off the very smallest amount that we were comfortable chewing on. And then fortunately found additional folks to come in as we were growing, to come in with more. And so it I think, was a bit of a natural trust building exercise. But we ultimately took that debt on in the structure of a promissory note to the parent company relative to a fund structure.
Okay. And then what are the milestones within fintech? Is it loan volume? Like how do you progress? When a typical company and venture capital is based on ARR and growth rate,
Mhm.
how does a fintech company get valued, and when do you hit these different inflection points?
Yeah, I mean, the nuance with what we're doing, and we're thoughtful about this, but there's two different types of fintech companies, at least in the credit space. There's those that take balance sheet risk, and there are those who do not. Frankly, the balance sheet component to our business, there's a reality where we bifurcate that from the technology arm of our business simply because we think the technology arm, once it really has critical mass and traction, could be more valuable as a standalone entity relative to the balance sheet lending business that we
Because
have.
it's higher margin.
Correct. And there's a different set of risks that come with running a balance sheet lending operation, obviously.
Hmm.
In terms of milestones, it's obviously loan originations. The metric that in the early days of fintech credit businesses was somewhat, I would say, overlooked is the reality that you need to look at what delinquencies and charge-offs are. Obviously, every good fintech business that's lending is pricing in what those delinquency and charge-off rates are into their pricing models, or I should say, target yield. But at the end of the day, it was very important for us to mitigate, especially in the first 12 months of lending, any types of charge off and delinquency behavior. So we probably had a tighter credit box than we necessarily will maintain going forward. But that was because we knew we wanted to sell into banks, and we wanted to have a very compelling story around the strength of our risk monitoring and portfolio management tactics and tools. So I think obviously loan origination volume, credit outstanding, um, number of activations, but delinquencies and charge offs are naturally the two others that are big. The other pieces are really just, from a capacity standpoint, and this is another metric that I may care about more than most, but you know, from a for every portfolio manager or account manager that we have on our team, what is their capacity from a coverage standpoint? How many businesses can they cover in their normal day to day and stay on top of everything with? Because in my experience, having worked at Bank of America Merrill Lynch, a large hedge fund, and now in the you know in worked on a variety of client engagements in my last role, I saw categorically, no matter how big these finance companies were, that they ultimately were looking at operational bottlenecks and just throwing more human bodies at the problem until it went away. And so our goal is to build a scalable lending operation where, rather than having, kind of linear growth between headcount and credit outstanding, our loan servicing, our risk management team is able to monitor their portfolio very much in a scalable way, and take that proactive stance using the tools and the insights that our platform derives without necessarily having to spend all of their day just culling reports on every single dealer that they have coverage of.
Okay. And so tell me about the go-to-market kind of motion, within Lever, right? Because Lever's the software arm, and Vero's more of the lending arm.
Reversed. So Vero's
Okay.
the software arm and Lever's the lending arm.
Got it. So that would make sense. So tell me a little bit about, the kind of the go-to-market, motion. And I mean, do you operate it similarly to kind of an outbound SaaS type company?
Yeah, we're kind of running a combination of both a traditional direct sales model as well as, more of the kind of scalable SaaS outreach programs. So naturally, the first year we kind of believed in the mantra of do things that don't scale, and you can really learn a lot from the hand-to-hand relationships you have with your customers. So we were out on the streets selling to dealers within our target markets, and really we just started selling into the banks in the last 3 months, but doing that on a very analog or traditional basis. We've since really started building out those indirect sales channels, or thinking about kind of the BDR up to escalating to an AE type approach, as we've started to put the pieces in place to scale. So our biggest emphasis right now is building indirect sales channels, or selling from one to many. And in a sense, that's what our bank partnerships provide us. So if we can partner with a bank who has 50 or 100 dealer relationships in their target markets, that bank then becomes a sales conduit for us. And obviously, our goal is to be able to help as many banks and dealers at the end of the day as we can reach. But it's much more efficient to partner with a single bank who gives us access to, 100 dealer relationships, in addition to helping those dealers acquire inventory financing through their preferred financial services provider as it is. So it's kind of a win-win working with banks to ultimately reach dealers who are in a way the end customer.
Do you have to like really work with innovative banks because to make sure that they know to push your product? I mean, how is channel sales through banks?
Yeah, it's obviously a it can be a very messy area or channel to sell through if you're not doing it the right way. We're very fortunate to be part of a program that's sponsored by the Independent Community Bankers Association, which really it's an accelerator for fintechs who are looking to work with community and regional banks, to identify and partner with those more forward-thinking banks who can really be your evangelists. So we've been a part of that program for the last 8 or 9 weeks now, and that's really allowed us to go from 0 to 60 on the banking partnership channels. And so there was almost a self-selection there where we've met with nearly 150 banks at this point over a very brief period of time. And those banks that participate in the program are naturally banks who are forward-thinking, who are looking to solve these types of problems.
I mean, I feel like if community banks really like, I mean, they could have the world by the balls if they so chose. I mean, to have the flexibility that they have, the competition of these big national bank brands is like abysmal. I mean, that they're terrible. Like I walk into a Bank of America and I'm like, dude, I'm your customer. And
Yeah,
like,
yeah.
like they don't give a shit about how much money you have or anything. Like it is absolutely abysmal. And community banks are dying, right, for things to sell. And we had John Wapsh on this show, the CEO of Nerve, who was also the chief strategy officer at Kasasa. And he was talking about just building these product lines through community banks and lenders, and because they just needed more stuff to sell. And they could actually come out with a universal brand, and they did very well doing that.
Yeah, I think we've definitely taken a page out of Casasa's book, in the sense of being able to help these community bank organizations be successful, but providing them the support to actually offer your product successfully is critical. And so you know, we have a customer success team for our dealers, and we also have a customer success function for our banking partners to make sure that they have the support they need to actually successfully utilize the program once they have access to it.
Yeah, so I really liked what you said about going out and being analog with your efforts. Going in, talking, bringing in a sales, carrying a bag, going in, meeting your customers. So, on a scale of 1 to 10 right now, John, where do you think you are in terms of the proverbial product market fit?
Really, I think of our business having a few different levels of product market fit. So, think of the level one business is inventory financing. And, given that we've funded more than $15 million in wholesale purchases in the first 6 months of really kicking our lending activities into gear, I would say that's about as close to product market fit for that level one business as we could have hoped for.
Now, level one
Um,
business being the actual credit funding business.
Yeah, so think about level one business is just providing inventory financing to auto dealers. The level two business is really working with banks to help extend that credit to their respective dealers. And then level three is some more of a technology play, which I can share more on a few months down the road from now. But the level two business being the working with banks to help them offer new commercial credit products. I would say we're just, beginning to ensure or beginning. I think we have the initial points of validation in terms of product market fit. We need to simply execute on the traction that we have. And I think, 6 months from now, when we are fully activated with the banks that right now we're going through kind of contracting phases with, and we have a track record of performance with those banks, I'll have a little more confidence in saying that we're at that 10 number. So let's call it five today.
Hmm.
Um, and that's kind of how we think about everything is, where our business is going to continue to expand. There's a lot of different directions that we can take it. There's a lot of ancillary, complementary products that we can add in terms of how we support our dealers or our banking partners. And so we think of product market fit as a constant evolution of, okay, we've got established product market fit and a high degree of confidence on one foundational component of the business. Now let's think about version 1.1 or 1.2, and how are we going to confirm product market fit about those around those additional constructs. It's not as straightforward as just okay, here's our one widget, and we want to take this widget from 0 to 1 billion. Our business is going to consistently evolve over time, where there's a very kind of multifaceted value proposition that we can bring to the table.
Sure. And so when you were doing more of your customer discovery, selling into the dealerships, getting this loan origination value out, how did you prioritize feedback to, offer the product? Because, and like how much of it was common versus, kind of stuff that just seemed to be one-offs or fringe cases. And how did you think about that as a founder?
Yeah, I mean, for the first 12 months, we were having daily stand up conversations with everyone across the organization to discuss any feedback they had received from any of our customers. So, whether it was someone on the sales side who was going out and prospecting for new business and getting feedback from cold prospects, or if it was someone on the account management side who was interfacing and supporting a dealer, or it was internal feedback, whether it be from operations, or someone who owned the banking relationship, someone who worked with auctions and other suppliers. We were raising and elevating all of that feedback, and then really figuring out, being customer centric is a core value. So dealer feedback was obviously elevated to the top of that prioritization matrix. But really, what was going to allow us to be more efficient, to be attractive to the most dealers. And if we heard something once, it was okay, acknowledge that feedback, but we have higher priority things to deal with. Once we started hearing feedback or similar details, week in and week out, then we recognized it was a commonality that was going to be leverageable across a broader swath of the market. So it's one of those things where we were moving very fast, but we weren't making fast decisions. We were prioritizing things based on what we kept hearing repeatedly, and use that as kind of a very fluid uh, function to evaluate how important something was.
Awesome. Awesome. And how did you end up doing, like, what's the origin story with you and, working within fintech and credit?
Yeah, I mean, I have a banking background, and BAML was, I felt like a little bit of a cog in a wheel there. Moved to an asset management business where, we started at 250 people. By the time I left, it was 400 people. We had gone through an acquisition, and still felt like on a day-to-day basis, I wasn't necessarily seeing the fruits of my labor. And so ultimately went to work helping incubate and stand up new businesses for a software development company that was based out of Copenhagen. And it was a great, call it, I got to start companies with training wheels. I worked in a space where we had funding. We didn't necessarily have to work with the venture side of the equation, but I was able to take a product concept, validate it, outline a go to market strategy, really kind of own product development as far as interfacing with our engineering team. And did that twice, with that group, at which point I was ready to go off on my own. And so I gained exposure to this segment of the market, through a prospective client relationship there. And it was enough to kind of open my eyes up to these more unique verticals within the credit markets. And initially, we had thought about just building out a commercial lending platform focused on inventory financing. But ultimately, we saw that the economics are a bit sweeter when you start doing the lending yourself.
And so tell me about CBX Market and your role there. Was that the venture studio?
Yeah, so it was actually a software development business. They did a lot of consulting engagements, and it was an idea of the CEO over there, Eric, who was struggling to manage his own personal fixed income portfolio and kind of recognized there was a lot of cost. I would say lower cost or cost attainable tools that were alternatives to Bloomberg in the equity space, but those tools did not necessarily exist within the fixed income markets. So they brought me and one other individual on board to take this kind of concept that Eric had and really a prototype, and figure out how to make it a business. And so it evolved into really being a portfolio management solution, very much purpose built for fixed income desks. Um, and we took that business, from 0 to 20 clients over a couple years, and then we had another idea internally as we were exploring applications of enterprise blockchain within the fixed income space, and that was really what led us to ultimately found Bond.One.
Yeah, and then what? Tell me about Bond.One.
Yeah, so the goal here was, we saw, especially within the securitization markets, that asset originators, so think about a mortgage originator who is packaging up a pool of loans and ultimately doing a securitization deal. There were, you had the originator, you had the servicer, trustee, administrator, issuer of the structured product, and there was a 30 to 60-day lag in terms of investors and asset backed securities actually being able to price in the performance of the underlying asset. And so we really looked at that value chain and identified certain areas where we could streamline month end reconciliation or even intra-month pricing of those underlying assets, using a platform technology that we had built out. So it was, I would say we were a little early on the blockchain train. This was really 2018, 2019, that we went all in on this. Um, at least in terms of selling a solution into institutional clients within the banking space. With that being said, we learned a lot about how those markets work, the inefficiencies that do exist, um, and gained exposure to a lot of more esoteric, kind of subsectors within the securitization markets, which ultimately is kind of how I stumbled upon inventory financing.
Okay. So what's the next 30, 60, 90 look like for you? You just raised
Yeah,
a monster round, monster seed round. So what's next?
Headcount on our team has grown 50% in the last month. We obviously made a bunch of hires, moving into the closing process. And so making sure that over the next 30 days, we successfully onboard those folks. Obviously, as the organization grows, people are able to actually really, everyone's still wearing a lot of hats, but we can refine and kind of go a level deeper in terms of scoping out people's roles and making sure that there's continuity in terms of handing off of processes that used to be owned by a single individual. So that's really the focus for the next 30 days. Beyond that, I think day 60, we have, like I mentioned, a handful of banks that we're moving through partnership discussions with. And so our goal is to go live with two of those banks in the next 60 days. And then really day 60 to day 90 is making sure that these banking partnerships go off without a hitch and get the support they need from the organization to make sure that it's a win-win-win for us, the banks, and their dealer clients.
And so what was important to you when you raised the money from an investor? Like, what did you want as an investor? And, how'd that relationship go?
Yeah, we wanted investors who truly understood, who either had unique experience within the space, whether that be auto finance, commercial lending, um, uh, some type of specialty lending type exposure, or investors who provided us really that kind of product and technical expertise, whether it be from data analytics, workflow automation, thinking about scaling a platform like ours where there is a very kind of multifaceted value proposition. So we're fortunate. The lead investors are actually, they have a legacy of investing in the credit space. They were early stage investors on a handful of other fintech lending operations, and really have also a breadth of experience within the auto vertical. Um, so the group at Arcadia Funds came in to price the round for us. And we filled out, the follow-on investors where it was folks that either had been with us since the early days, Antler, for example, and really understood how we operate from a management team, how we, what we believe in terms of building out the right profile of an organization, and sourcing talent to support that model. And then some other folks who either have, a variety of kind of vertical integration experience, or relevant platform building experience, I should say, from a product perspective.
Yeah, I mean, having operational partners within a venture firm that can help with the, continual evolution of product market fit is invaluable,
It
right?
really is.
I
Yeah,
mean,
I think especially as you start thinking about making more frequent bets in terms of which direction to go from a product road mapping perspective.
right. And it's just having product market fit. It just seems like there's just so many less shortcuts than saying scaling, right? Where scaling, all you really need to do is know how to hire the people that know how to scale.
Mhm.
Whereas somebody with product market fit, I mean, that is a job that's solely based on, the founder, you and Isaac, and then, and your customers. Like there's no shortcut to that. You can't hire for that.
Yeah, yeah. I mean, you definitely want to find folks who, and it depends what role they're taking on, but who, for example, our VP of credit has operated in the space for the last 15 years, and before that, he was a car dealer. So he's been on both sides of that
Okay,
equation.
cool.
And so David has been able to help us think through, how do we manage portfolio risk as we're scaling? And so that was a critical hire where we needed that domain expertise. Um, but when it comes to product market fit, we're trying to envision, what the next generation of inventory financing is, and really a platform where inventory financing is just one component of the value proposition. And so that's something that obviously is much harder to paint the picture and then lead the ship towards.
Right. All right. So, kind of canned questions time. What's your favorite book?
Uh, Fiction or nonfiction?
Nonfiction.
I have a really good answer for you if you said fiction.
Okay. What
I
is a
would say
fiction?
fiction is Gentleman in Moscow by Immortals.
Okay.
Great, great historical fiction read. You
L-
really fall in love with the characters.
Do you know what's really funny is that I've actually had somebody on this show who said Gentleman Moscow is their favorite book.
Really? Yeah,
Yeah.
he's got a few really good ones. Rules of Civility is up there as well. As far as nonfiction, though, I like The Hard Thing About Hard Things. I think it's a Horowitz book. Um, I I really like, actually, this is a good one. Designing Your Life. The authors' names don't come to me off the top of my head. It's two Stanford design school professors. One of them was an Apple product guy before he got into academia, but the whole gist of the book is effectively a thought exercise to take a product development approach to being thoughtful about what your ideal life circumstances look like. So whether that is, what kind of career do I want to have, who is the right partner for me, how do I spend my free time? It's a very thoughtful and productive kind of approach, especially as you're thinking about charting out what your career looks like. So it was a book I stumbled on back in my kind of mid 20s, and it was definitely at a pivotal moment when I was able to really take advantage of the exercise.
Nice. Best piece of business advice you've ever gotten?
You don't do business with businesses, you do business with people.
Nice. I like it. Okay. And then who's somebody you like to follow?
Um, for better or worse, I'm a big Ray Dalio guy. It's probably turned me into a little bit more of a cynic as far as what the future of the world holds for all of us. But I think it's very practical guidance in most cases, and it's definitely grounded me a bit.
Yeah, I love Ray Dalio. I love what he does. I really hope he's wrong. Um,
Yeah, I believe he's right more
yeah.
often than not, but I don't know. We're living through a very interesting geopolitical moment and potential shift right now. So,
But the
if
Changing World Order book, I mean, it's like it's almost like a prophecy. It's like everything is coming into fruition of what, he's talking about.
you know, it's a great read if you want another kind of counterpoint to Ray Dalio's view of the world. Read The Next 100 Years. Um, as you can tell, I'm really bad with author names, but The Next
Mhm.
100 Years is by a geopolitical theorist I think he runs a think tank in Washington, D.C. He wrote it in 2008 around kind of a decade by decade approach of what the shift in the world order looks like. I read it in 2018 and it was pretty mind blowing that shit he had suggested 10 years prior was in many ways coming true. So who knows?
Yeah.
It's nice to get some alternative views so that you're not all in on one thinker.
Absolutely, absolutely. You have to have a balanced content diet, I think.
Yes, critical, because
Um,
otherwise you really can go nuts. So
well, yeah, and you become very intellectually lazy, right?
yes,
And if you don't do the work, it's just garbage in, and then what happens is your garbage output in your actions. So,
yeah,
you know, I,
you stop being discerning about what you're hearing and from who, and you just take it as fact.
exactly. All right. That is a wrap. Thank you so much, John. This is the Capital Stack podcast where we talk to founders, entrepreneurs, all investors, value creators for disruptive and innovative solutions for problems that are out today. Thanks again, John. I hope to have you back sometime soon. And if you like this, please share it with anybody, or like it, add a review. You can find us on all major podcasting platforms. You can search my name, David Paul, or the Capital Stack. And we'll see you next week. Thanks. Bye bye.